The cost of dining out continues to outpace your weekly grocery bill. Meals at restaurants and bars cost diners 4.5% more compared to a year ago, with restaurants honing in on price hikes due to persistent labor inflation. But despite those stubbornly high restaurant prices, our next guest is still bullish on fast casual names like Chipotle and Yum brands. And for more in the sector, we're joined now by John Tower, Citi Director and Restaurant Analyst. So thank you for joining us here today. Break down your view for us on some of these faster restaurant names that you're covering.
Yeah, thanks for having me. So we're constructive on Yum, Darden, Chipotle, and a few others in the space. And effectively, there's a few things we like about them. From the fast casual standpoint, we think that those businesses have fairly strong momentum, and what they're doing is carving out a category that sits obviously between full service dining and limited service dining, an attractive price point with higher quality food. And those are still in their infancy in terms of where they are with respect to growth and the opportunity in the US and abroad. So we think that where they're hitting with the consumer right now, especially with this respect to the demographics, they're hitting younger, they're hitting wealthier. That works really well. And given the backdrop in the US at the moment, where it appears as though the lower income consumer is cutting back quite a bit on their consumption away from home, perhaps pivoting to grocery as an alternative. We like brands that have momentum. Yum Brands is a little bit unique in that they're a global quick service operator. We like them because, frankly, they continue to open stores across the globe. They're using franchisee capital to make this happen. And specifically, what we like that's slowly emerging for them is this digital platform that they've built out, effectively creating capabilities for their franchisees that allow them to become more digitized across their system. And Yum is going to be capturing more of that revenue back to themselves instead of farming it out to third parties as they previously did. And we think that's going to allow their franchisees to become more profitable, which will then fuel greater unit growth across the globe over time, across the three major brands that they have. So
John,
those two, Chipotle and Yum, are right up there.
Yeah, John, I'm curious to get your perspective on the pricing strategy for Chipotle and Yum. How do you see that playing out going forward, given the fact that, yes, prices are obviously still higher than they were a year ago in many respects, but we're not seeing anywhere near the type of increases that we were a year ago?
Yeah, I think the argument can be made that so long as employment and jobs continue to grow and wages continue to move in the right direction, particularly in the US, there is room for these restaurants to continue to take some modest pricing, right in line with inflation. And you think about it, they're considering the costs. The primary cost buckets are going to be food costs and labor costs. And both of those, food inflation's come down relative to where it has been in recent years, certainly labor inflation as well. However, they're still moving upward. And so the idea of these concepts going from, say, high single digit, in some cases, high or low double digit pricing down to low single digit pricing makes sense. Now, obviously, there's markets like California where wager rates are going to be shifting quite dramatically starting in April, and brands are going to have to price to offset that in the market. It's TBD in terms of how that plays out for demand. We're a little bit more nervous for brands that have overexposure there and haven't had strong momentum in underlying traffic going into this period of likely higher prices. Could you see traffic drop off pretty dramatically in response to that? Yeah, you could. But those brands that have momentum, which means they've been giving a fairly strong consumer proposition for some time, right? Typically good food on the plate and strong throughput. We think those brands are still going to outshine the rest of the category. That's your Chipotle is a good example.
And John, I just want to focus in on Starbucks for a second. We've been talking about the labor market, labor costs, and Starbucks is no stranger to labor relations. We'll just cap it there. You're writing in one of your recent reports, Starbucks remains the most debated name in your coverage universe, with interest ebbing and flowing around key investor events and bears seemingly controlling the narrative over the last few months. What are some of the events we're talking about here, and how could we see that evolved in the share price?
Yeah, so they've had a number of investor events the past couple of years. More recently, it's been around earnings and investors kind of setting up as playing the game or effectively trading around events, our expectations above or below what, broadly speaking, investors are anticipating. And effectively, the stock has unfortunately moved into a bit of a trading range rather than kind of this persistent growth forward that many people have been used to with this name for a very long time. There's a lot of issues that we think are happening at Starbucks at the moment. First and foremost, stumbling traffic in the US. It's really kicked off since mid-November. And it doesn't appear, based on the data that we can look at, that it's improved that much starting this calendar first quarter of 2024. And, we don't know the exact causes for it, right? There was some problems with labor earlier around the Red Cup Day in November. They appeared to get tied up into some social media confusion. Was that part of it? We don't know. But, when you look at it, this is a brand that is premium price point, but they've got over 16,000 stores in the US. They're bigger than McDonald's, right? So that means their customer base is representative of the US. And that means they're going to have consumers that play at the low end and those consumers that play at the high end. But when low income consumers start cutting back on spend away from home, they're likely going to feel it in their model. And I think that's what you're seeing here. Their most recent earnings call, they spoke about the afternoon seeing the greatest pressure in the US. And I think that's a function of that being the most discretionary occasion within that kind of beverage away from home event. And then, there has been competition abroad has been a bigger issue than it has been domestically. Domestically, I'd point to C-stores in likely the form of, alternative energy drinks as potentially being a greater value for the consumer relative to what they can get today at Starbucks. And that's been weighing on their business. So I think, what gets this to work, we outlined it in our note. We think that, there could be some major changes that need to happen, but more realistically, what could happen, I think if the company articulates some of the cost savings and really dives deep into whereabouts in the model these changes are taking place. They've outlined about $3 billion in cost savings over the next several years. They talked about 2/3 of that coming outside of the stores, really hand-holding for investors how this is going to play out over the next several years will at least provide some confidence that the earnings growth that they've targeted of 15 to 20% or so the next few years will come to fruition, even during this period of more kind of tumultuous sales and traffic in the U.S.
All right, John Tower, always great to get your insight. Thanks so much for hopping on and talk to us this morning. Citi's Director and Restaurant Analyst. Thanks, John.